Hi everyone. Now that we've talked about revenue forecasting, we'll be moving on to the other side of your financial forecast, costs. But before we get into the modeling, I wanted to talk a bit about the concept of cost, and in particular the difference between direct and indirect expenses, as well as the process of forecasting each of these. First, direct expenses. These are the direct cost of providing your goods to a customer. The best way to think about direct costs is, if you did not make a sale, will you incur this cost? If the answer is no, then it's probably a direct expense. For example, for an online store, your direct costs include the cost of sourcing the product, your online transaction fee, and other services like delivery costs. All of these costs will be avoided if you did not make that sale. Whereas costs like maintaining your website, your call center, and any advertising will continue to be incurred regardless of the sale. These are your indirect costs. While indirect costs are incurred regardless of a particular sale, you may want to adjust your indirect cost over time in response to changes to overall sales numbers. But these changes are unlikely to be immediate. For this reason, the model allows you to enter two types of indirect expenses: fixed or semi-variable. Fixed expenses are like accountant fees that are likely to remain constant even if significant change occurs to your revenue. In comparison, semi-variable costs are like the number of sales staff you hire that increases over time if your revenue picks up. But unlike direct costs, they will not increase for each sale. Now that we've gone through the characteristics of each of these, let's talk quickly about forecasting for each. A key consideration for small businesses is to focus on things that make money. Focus on your revenue and how your expense supports your revenue. Often it's not a good idea to spend too much money on things that don't lead to greater sales. For direct expense, in addition to just the cost required for each transaction, think about how this may change as your revenue increases and your business grows. Is there a threshold where your direct costs will reduce due to the economies of scale? For example, coffee beans are cheaper if you buy in the bulk, meaning you can make more per sale. For indirect expenses, think about at what level of revenue will you need to increase indirect costs to support your growth. The same principle applies to asset purchases, but we'll come to this in a later video. To reduce risk to your business when you are starting out, seek to minimize indirect costs, because if your actual sales is below forecast, you'll still be left to pay those indirect costs. In the next video, we'll be looking at expenses in the model and how to link these to revenue drivers. Thanks for watching, everyone.